Investors fear the world is barrelling towards 1970s-style stagflation. The ASX had its worst day in more than 2 years yesterday, wiping out nearly $100 billion from the share market. Tech stocks led yesterday's decline that saw the market down more than 10% from its peak last August. Central banks will be forced to choke off post-pandemic recovery and push unemployment higher in a drive to tame growing inflation. The Reserve Bank governor rejected suggestions of a recession, saying he expects the economy to grow pretty strongly over the coming year.
Around $80 billion was wiped from the value of Australian shares as it plunged some 3.5%, but it wasn't the worst. At the opening, it had been down some 5.3%. There was some catch-up in all of this as there was a public holiday yesterday, yet the US and the Asian markets had continued to fall. But the real worry is about a future recession, especially in the United States, that may go around the world, including here to Australia. Certainly that's what the head of investment strategy at Perpetual, Matt Sherwood, thinks is coming.
Futures markets are pricing in a lot of rate hikes here in Australia. So just in the last 3 weeks, they put almost 1.5% extra rate hikes. So that's something the highly indebted Australian economy and highly cyclical Australian economy would react very poorly to.
So the types of stocks that were hammered were really tech shares and mining shares. That came as a result of falls, not just in oil, but also in iron ore. And so some of the biggest companies, including BHP, were hit hard. But on top of that, many of the tech shares that don't make money, including, say, buy now, pay later company Zip, were also hammered, as really their viability into the future will be questioned. What happens in the future, of course, is really dependent on what happens with Australia's economy. For now, things look pretty good, according to the National Australia Bank's chief economist, Alan Oster.
The Australian economy is doing really well, and to be honest, you've got to remember that monetary policy takes 12 months to have much impact. So if you're going to have a recession, it's not going to be this year, it's going to be next year.
The real issue is just how high the Reserve Bank now has to raise interest rates to try and quell inflation.
They'll go to about 2.1% by the end of the year and maybe 2.6, 2.7 by the end of 23. Markets, on the other hand, are talking about, 3% plus.
Ross Greenwood, Sky News.